Good afternoon. Welcome to one more panel, our ninth Brazilian Congress on International Tax Law. Still online modality. We hope next year we will be doing it in presence and see and be with our peers. And we have a subject, international taxation and economic recovery and the role of emerging countries. Our event is done by the Brazilian Institute of Tax Law and Department of Economic Financial Tax Law at Largo São Francisco Law School, USP. My name is Anderson Trautman Cardoso, and I thank the kind invitation made by Professors Luiz Eduardo Chueiro, Luiz Flávio Neto, and Rodrigo Maito da Silveira to chair this panel that we open now from 3:30 up to 5:15, talking about an important subject, which is Pillar 1, Perspective of Developed and Developing Countries. Important subject regarding harmonization tax-wise, regarding an important source of added value of our economies propelled by the pandemic, which is digital economy. And we also have we are fortunate of having with us the moderator of this panel, Professor Cláudio Tartarini. He is a master and student in international tax law and comparative tax law of IBDT and a counselor in Brasília and São Paulo. We also have as a panelist with us foreseen, but we will not have Dr. Luiz Guilherme de Medeiros Ferreira. Unfortunately, due to professional commitments, he will not be with us, but we will have fantastic panelists with us. First, Allison Christians, thank you very much for your availability to be with us. Belema Obuoforibo, thank you for the kind availability of your time to be with us. Cláudia Utumi, Ana, thank you for the availability. And Yariv Brauner. Yariv, thank you so much for your availability to be with us in this panel. Now I pass the floor to Dr. Cláudio for the kindness of dedicating to the organization and elaboration of this panel and will be the moderator of our debate as of this moment. So you have the floor, Cláudio. Thank you, Anderson. Thank you, our chair of this panel. And I wish you a very good afternoon. It's a pleasure to be part of this afternoon and IBDT, especially for the opportunity to participate. Professor Luiz Eduardo Chueiro, Luiz Flávio Neto, and Rodrigo Maito da Silveira, and Dr. Ricardo Maris de Oliveira, the chairman of IBDT, and thanking Anderson that spoke before me. And I would like to use this moment with a brief summary. I will be talking about important points that he's an expert in tax law by virtue and also financial and economic by the federal universities amongst other attributions and representations he is present. So I summarize. Otherwise, I will take half the time given for this panel if I will list all. And talking about the subject of this panel, I'm very happy because it's one of the subjects of my research, which regarding Pillar 1, as was said, and the perspective of developed and developing countries. During the morning, the Congress, we had a debate, the first panel, where we talked about the importance of tax withheld at source and taxation by what we call digital tax, and also the role of Articles 12A, 12B of UN Convention regarding double taxation in this outlook. And this is one important aspect for developed countries and developing countries and what we call emerging countries. Here we try to give details and drill down on the debate with our lecturers regarding the Pillar 1 subject, which is part of the agreement and work produced by both pillars and resulted in a agreement and proposed by OECD as an option compared to the different approach. And without further ado, the panelists will explain. I'm just introducing the subject. I would like now to say that each lecture will have 20 minutes. This is the idea. So by the end, we have 20 minutes for final remarks. So we will follow the alphabetical order. So before starting, I would like to say that we have a Q&A, as you well know. Please pose your questions there because it's very important for the debate, and you have the opportunity later on for these questions to be selected according to time given. And please pose your questions so they will be debated by the last panel of the day that starts 5:30. With this, I present the first lecturer, Professor Allison Christians. She's a professor of comparative law and a huge resume she has, but in the University of McGill University in Montreal, Canada, and she teaches and studies tax policy, and her focus is taxation and relation with the human rights, economic rights, and the role of governmental institutions and NGOs regarding setting forth norms, international standards, and tax policy. With this introduction, I pass the floor to Professor Allison Christians. Please, the floor is yours.
Thank you. Well, thank you so much. I got to change my to original audio, or I get a little extra audio there. So thank you so much. It's such a pleasure to be here. I thank you, IBDT, but the second time I'm presenting in this wonderful conference, this global extravaganza of tax policy. We've learned so much. I think all day I've been listening to all the presentations and learning as we go. So I'm going to, share my obligatory official slide here, the title of my presentation, Between Two Pillars. I'll try to make it obvious why this is the title of my presentation. But I have to first start with, to really get it in your mind, between two pillars. We have two to work with here, and I really want to emphasize that. So I want to start with pillar one. That's our top of our panel today. So the question for me is, well, who needs a pillar to tax these guys, these fangs? And you see in the question mark, that it's not just these big ones, but it's apparently maybe 78 companies or maybe 100, depends on who you talk to. But who needs a pillar to tax these guys? Well, there's a few factors. One factor that you need if you might need a pillar to tax these is if you have few or no headquarters companies. So we sort of start from this idea of like, well, where are these companies coming from? Well, if you don't have any of them, then you might need a pillar to tax them. So if we make a scale of our pillar, from 0 to 70% of the possible companies that might be subject to amount A, I think you can guess who the big full pillar is here. I don't really have to give too many hints here. I think you already know that that's the USA. But did you know that the rest of the world, what the other headquarters are? Well, it sort of looks something like this. China, Britain, the Netherlands, Germany, France, Japan, and then the rest of the world has but a sliver of headquarters companies. So if you're not on here, if you're on the rest of the world, with a sliver of headquarters companies, then you might need a pillar to tax these big digital giants. Okay. Factor 2, you have source limiting tax treaties. Well, we've heard a lot about that, I think, all day. The great theme of international tax right now is source-based limitations and loosening up the source country tax. So if you have treaties that limit your source taxation, then you might need a pillar. You might need a pillar to tax digital giants because your treaties do things which we've already seen. So just quickly recapping what we've already seen. If you have no PE in the country, then you can't tax without a pillar because of your treaty. If you have a PE, but there's no active income, you can't tax. Maybe a pillar might help you. And if you have strict withholding, that is, if you don't have any tax on other income, for example, or other ideas about what withholding can and can't apply to, you might need a pillar. And so there's kind of like an oopsie there, like, oh, so a bunch of countries limited their source taxation and then looked around and realized that the world was dominated by giant multi-mega nationals, almost all of which are headquartered somewhere else. And now we need a pillar to tax them. Okay, so that's factor 2. What's the third? I have a third factor here, and it's that you have some risk here. That is, you have exports to the USA or these other headquarters jurisdictions, which they might be able to hit you with a tariff if you use something else, like, for example, a digital service tax. Okay, so just in case anybody's been living under a rock, you all know that the USA did 2 things that made tariffable exports to the USA have something to do with why you might need a pillar to tax digital multinationals. The first of these factors was to dismantle the WTO appeal system. It's complicated and long, and I'm sure others know more about it than I do, but and then use the process, using the domestic legal process about fair treatment, equitable treatment, discrimination, all kinds of like internal language, domestic language, and use those processes to threaten what the US calls counter tariffs, when actually they're just tariffs not consistent with the WTO. But if you don't like what the US is doing, and you say, well, what they're doing isn't consistent with agreed trade terms, then you could appeal. But C.1, you're appealing to the void. You could go get a WTO ruling, but if they decide that the US has done something wrong, no one can appeal. And if they decide the US hasn't done anything wrong, you can't appeal. So if you have exports to the US and you face possible retaliation, then you might need a pillar to tax. Now, starting right away in the beginning of the day, we had a colleague from Russia explain, that the US wasn't going after them for their digital service tax. So, it doesn't mean you need any of these 3 factors. It's just they seem to be relevant to those questions about who needs a pillar to tax, those 3 factors. Okay, fine, but who doesn't need a pillar to tax? Like, why don't we ask ourselves that question a little bit more often? Well, okay, obvious answer. If you've got lots of headquarters companies, then you don't need a pillar to tax those companies because they're quote unquote your companies in the sort of traditional way of thinking about things. But as we saw, 70% of the companies are headquartered in the US, and there's sort of a sprinkling in some other countries that we can just assume this isn't kind of our issue here at all. We're thinking we're the rest of the world with a tiny sliver of headquarters, and we're trying to get some tax out of these nationals. So do we need a pillar to tax that? Well, here's the thing. If you don't have a tax treaty with the US, and of course, like with, maybe with China or some of these other countries, if you don't have a tax treaty, then you don't actually have any limits on your source tax. Go nuts, go wild, do whatever you want, right? Don't worry, I'm going to pull back on that ridiculous and crazy claim in a minute. But that's the basic idea. Like, nobody can stop you. You can tax whatever you want. If you don't have a tax treaty, you don't have any obligation to fulfill some global norm of like goodness and kindness. You can just tax whatever you want. And the question is not, can you tax? It's just whether can you actually get it? Like, can you grab the taxpayer and, turn them upside down and shake out their pockets to find the money? Because if you don't have any way to do that, you have the same problem that we've had for 100 years, hard to tax companies that don't come to your jurisdiction. But, in principle, tax whatever you want. If you don't have a tax treaty, you haven't stopped yourself from taxing those companies. So that's a big a lot of countries don't need a pillar to tax companies if they don't have a tax treaty with the US or China or whoever. They don't need any special permission. Nobody has to come and give you the "you're allowed to tax" card. They can just do it. But what else? Well, what if you do have a treaty, but you have, like, in the treaty, you have a broad view of rents and royalties? For example, you think platform rents might be in rents, or, as we heard, I think a little bit today, here and there, royalties could be expanded to a lot of the kind of fees that we think we might be able to get some withholding tax. Okay, or you have a source tax on the category of other income. There's some discussion, people go back and forth. We live in a very conservative field. You all know we're very careful and, cautious about expanding ideas and, these sorts of things. But people get bothered when I say, well, you can just tax, use that other income provision and just hit them with a withholding tax. People don't really like that too much, but okay. So it's an option. If you have a tax treaty and you have a source tax on other income, why wouldn't you use it? I don't really know. Or you could use, as we've heard a lot, UN Articles 12A, 12B. So even if you have tax treaties, maybe there's some room already in the language you have, or you could adopt, some emerging norms, whatever. But okay, so here's the big but. I know you're all screaming at me, virtually, digitally, like, no, Allison, you can't do any of those things because I'm worried I have a risk of double tax. And my major risk of double tax is that somebody's going to stop, not give me a foreign tax credit. And if there's a foreign tax credit limitation, then as a source country, I don't want to tax if I'm not going to get that credit somewhere else, because then it's going to either be double tax or just a tax that doesn't exist at all. And anyway, I don't want to do it. It's risky. It's very risky. And so we've seen this a lot. There's a kind of a few ways you can get a credit limitation. These are just some examples. The first one is a haircut, guilty, you only get 80% of your foreign tax in guilty right now. That might be a reason not to try to get more tax at source, even if you thought you were allowed to. Or you have category limitations, and I'm going to come back to this in a minute, but this is the idea that, well, the US only and other countries only give you a foreign tax credit in respect of the foreign tax that's actually on income. And the US use word like in the US sense, but you'll see like attempts to make sure that you only get a foreign tax credit if it's really a tax on income. And that's where you get that in lieu of language. We've heard some of that earlier today, I think. And you get this idea that, well, withholding taxes, they're not actually income taxes, they're gross basis, they're not net. That's very strange. How do we fit that in the income tax? But the US already did it, so therefore they are allowed to be credited. But you can see the US getting a little uneasy about that sometimes, and other countries getting a little uneasy about that. Well, we want to make sure you're not giving any refunds behind closed door or in some other form. So there's going to be category limitations to make sure it's really the kind of tax we want to give a credit to. Or we have these substance limitations, well, like the US new substance limitation where you have to have a nexus, substantial presence, whatever, some nexus to be able to say that it's source-based tax, whatever. And so you could maybe worry about these kind of things and think these are going to be in the future and they're going to risk use and double tax. Okay, fine, I agree with you. But what if we pretend that consistency is something that countries care about, that actually, even as we're all thinking about Pillar 1 and digital services taxes and how to, whether you have to revise your treaties and if you have to sign onto the inclusive framework or not, when you're going through all these problems, what if you pretended that it mattered, that there's principles somewhere in here that we have to think about and that those might be changing? So, well, in that case, we have to not forget what's happening over at Pillar 2. And that's why I started this presentation by saying this presentation is called Between Two Pillars, because I think you can't stop in Pillar 1 and say, we're isolated here in Pillar 1 and we're only thinking about Pillar 1 things, and it has nothing to do with Pillar 2. I know a lot of people like to say that the two pillars are inseparable or they're completely separate and that they're in two categories and they don't cross, but that's nonsense. All international tax is interrelated, and when you put a principle in one regime, you can't pretend it doesn't exist when you go to the other, or at least I can't pretend that. I suppose some people could pretend that, but I think it's important to remember, like, okay, let's go see what's happening over at Pillar 2. Well, I know this is a Pillar 1 panel, but bear with me. If you haven't looked at Globe yet, you probably should. here's the basic idea. You have a country A with a high corporate income tax rate, and let's say they also have a CFC regime. And the OECD calls that the ultimate parent entity when they own the other companies underneath them, and together it's the group, the MNE group. And the problem is that country B, naughty country B, only has a 5% corporate income tax rate. And so we have a situation of possibly B company being a low tax constituent entity. Well, a funny thing happened on the way to deciding whether B company was a low tax constituent entity. If B company is that, if we decide they are, then Globe adopters have been given permission, right, somehow. Nexus node, I don't know, it doesn't seem to matter. It just, if you're in the MNE, Globe adopters can grab a top-up tax. So if they look at B company and say, oh, you only have 5%, that's not 15, that's not the agreed rate, we're going to grab the other 10%, right? You might think that's the answer, and I'm sure plenty of people will tell you that's the answer, but they're wrong. That's not actually the answer. That's not quite right. Because of the CFC regime. So, and I don't know if you know this, but in the Globe rules as released last fall, they added this idea, maybe the worst acronym ever to be developed in the history of international tax. I don't know, I think we should have a contest, but certainly QDMTT is somewhere in the list of worst acronyms ever. It makes people hate tax law, but we have so many of them now. We just have to learn to live with them. But you know that in those rules, they decided, okay, so if B company is a low tax entity, Globe adopters can grab a top-up tax, but low tax countries are allowed to adopt a new tax at source to grab those new revenues first, so long as they call it a QDMTT. And by call it a QDMTT, I mean so long as they follow a couple of rules. Okay, well, okay, that's fine, but then what about this? To decide if B company is a low tax entity, Globe says add the shareholder level CFC tax. Not all of it, because here country A's 25% corporate income tax is higher than the agreed 15%. So there might be a haircut in how much you push down to the B company, but check this out. Just consider what's happening here. What's happening in Globe in Pillar 2 is that a CFC has become a soak-up for the Globe top-up tax. It is a soak-up tax. It is a tax that if you impose a CFC tax, the Globe tax will be smaller. So it's grabbing, there's so much tax going to be available, and you could tomorrow, residence countries could adopt more CFC taxes and they would grab more of that top-up tax even if they don't join Globe. Now, I'm not here to harp on about Pillar 2, but I'm telling you that it's important once you decide that a CFC tax comes before the calculation of the top-up tax, and that the top-up tax is developed by reference to the CFC tax, that what you've built is a soak-up tax system, a system which it's allowed to raise tax in one place that will grab the tax from the other one before they're allowed to grab it. But if that's true, and it is true, then look at this. The QDMTT is also a soak-up tax. It's specifically, explicitly designed to be a Globe top-up tax soak-up. That is, you're supposed to create that QDMTT to grab the revenue before the residence country, some residence country somewhere, grabs your top-up tax. Okay, if a CFC can soak up the Globe top-up tax, and a QDMTT can soak up the tax of a Globe top-up tax, then why can't a QDMTT also soak up the CFC tax? Okay, hear me out. Why can't countries adopt taxes that only apply if some country somewhere else is going to adopt or already has a CFC tax? If the OECD is telling them that now that we have Globe, you are allowed to specifically write a rule that only applies if some other country is going to grab your top-up tax. Now, the reason to go through this whole exercise is to say, if you're worried about foreign tax credit limitations, doesn't your worry stem from the problem that we had in the past, which is that countries would limit foreign tax credits if they said what you were doing was trying to soak up their residual tax credit, but now they made Globe, so that's over? That's, I think, a big implication of what's going on with Pillar 2 that we haven't thought about in terms of Pillar 1. But look, we're very early in the process. writing the rules is not the end. It's not the end of anything. It's the beginning. It's you write the rules and then people start reading the rules and interpreting and applying the rules. And then you see all the mistakes, the cracks, the gaps, the overlaps, all the faults in the law. And then you start to reconfigure. But here's the thing. If Globe is telling you can do soap cup taxes for Pillar 2, then what's going on in Pillar 1? If Globe has changed the norm on soap cup taxes, effectively, you can't stop people, countries, you can't stop countries from adopting qualified domestic minimum top-up taxes, which are very specific alternative minimum taxes that apply only when some other country would otherwise apply a top-up tax. If Globe has changed that norm, then is what's good for one pillar good for another? If Globe says it's okay to do that, then why wouldn't you have source-based withholding that's completely and only going to apply if a CFC tax applies somewhere else? And how is a country going to say, no, you can't have your foreign tax credit on that? Because why? What's the principle? Okay, if the answer is no, you can't have it, I think people will have to start giving explanations as to why. And I know that there will be lots of people who think that what I'm saying is radical and can't be supported. But when I read the rules, these are the norms that we see unfolding in front of us. So I'm going to stop right there with my obligatory thank you so much slide. I look forward to hearing what the others say on this panel, and I thank you so much for your time today. Thank you.
Thank you, Professor Allison. Fantastic your presentation, connecting both pillars. Brilliant. And then now I introduce the lecturer, Cláudia Utumi, professor, from the professor of the Professional Masters of IBDT and by UPSP PhD partner of Utumi Attorneys at Law. Just to summarize her huge civil CV, so Professor Cláudia, the floor is yours. Thank you very much, Cláudio. It's a pleasure to be here, and I thank beforehand the invitation by Professor Chueiro, Flávio Neto, and Maito, and I congratulate for the success of this event. I will share with you my screen so I can present. Well, very interesting the debates we held today regarding the taxation of digital economy. And in fact, we must see from the different points of view. Professor Allison showed important and interesting points of view, and my idea is here regarding the optics of developing country and showing Brazil in this case. What I'm going to say regarding Brazil, we also find in other countries of Latin America. I have held debates with representatives of other countries of Latin America, and the impressions are very similar regarding the perspectives of development and regarding Pillar 1. One of the points I would like to start addressing is Brazil is a huge market for digital services and products on an overall. And when Professor Allison mentioned the countries that are the residence of investors or companies or no companies, significant companies in digital economy. So in Brazil's case, we are a big recipient of foreign investments, which have an importance which is considerable throughout all the years in foreign investments in Brazil, it's something very strong and important. And also, it's interesting to see that it's not that Brazil does not have the capacity to generate multinationals in the digital economy area. Conversely, Brazil is the cradle of good, big ideas of digital ideas and huge tech development. But the problem is that by reason of several reasons, including tax, we have seen in Brazil a change similar with what we call the inversion of Brazilian companies when they become multinational and start to grow. They invert in such a way that their holdings are located in the Cayman Islands, USA, Netherlands, becoming huge global companies. And here we have several that are unicorns, Brazilian unicorns, in fact. But in fact, they are instead of Brazilian multinationals, they become international companies. When you say that we are a big recipient of foreign investments, what I'm saying, and including those companies that we call Brazilian unicorns because they were ideas were born and flourished in Brazil, but when they become multinational, they end by becoming international company. Multinationals are not Brazilian multinationals. So Brazil, we have few genuine Brazilian multinationals. So when we talk as an example, so statement Brazil, country to country, I'm sorry, the number of Brazilian groups that must do country to country statements, it's a feeble number, more close to 50 groups than 100. And in addition to this, when we look the multinational companies that operate in Brazil, we see that most of these that have subsidiaries in Brazil, so we can say if you have a subsidiary, at least you have a local transaction. But most of the time, subsidiaries, they operate more as a support to activities of the controlling company, foreign controlling companies or some companies of the group, than specifically a business unit in Brazil. With this, we mean that many times, most of it in time, the local subsidiaries, they are not remunerated by the client and consumer. They are remunerated by the foreign company, and that remunerates the local position only with a cost plus, in our case, due to Brazilian rules of transfer pricing, cost plus 15% is sufficient to meet the transfer pricing rules. So they are remunerated then many times by cost plus transfer pricing 15%, and Brazil stays with not much profit of the digital economy. So first analysis, when we look the first scenario, one feels that Brazil would be a strong candidate to implement running Pillar 1 in order to bring a bigger share of digital companies' profits. And also, we must recall and take into account that Brazil has taxation on digital services. We have a taxation of digital services, so we did not create a tax on services, digital services. There's no specific taxes on digital services, DSC, like other countries. What we have in Brazil is that we have taxes with the conditional circumstance of clients to include scenarios of digital economy. So to include situations of digital economies, and with this and due precisely of this possibility of including situations of digital economy, that as much as we have a situation, the National Congress, of a tax on digital services, in fact a siege, digital siege, these debates are not moving forward as one would wish, because we have too much taxation on digital services, and also this taxation, part of it also being levied on the remuneration on intangibles of the digital economy, royalties and others of intangibles. So we have currently income tax at source of 15%, ISS tax on services ranging from 2 to 5%. We have social contributions on importation, PIS, COFINS importation 9.25% on the Brazilian payer, and we have siege royalties, special tax on royalties and services 10% on Brazilian payer. Although we don't have adopted a specific measure of taxation on income on digital revenues, but we have wide taxes enough to embrace situations of the digital economy. Now, as for what is being internationally debated, Brazil not only is part of BEPS inclusive framework, but it's also part of the steering group, i.e., so it's part of the strategic group of BEPS. And also Brazil is one of the almost 140 countries that approved and supported the statement of two pillars of the 2021 group. But a point I would like to stress is that one thing is showing one's support to these studies and debates. Another thing is implementing, in fact, the measures. So, we, in fact, up to date, not even signed the multilateral agreement, the MLI. We haven't executed, and we are negotiated agreement by agreement to place measures that will meet the minimum standards of BEPS that exist of existing agreements. That will say the pillar will come through a multilateral agreement. We have here a question: what are the chances of Brazil signing this multilateral agreement? But if we look the first point of view, Brazil being a big receptor of investments and not having multinationals of digital economy that will centralize its activities here in Brazil to tax through the domestic legislations we saw with Professor Allison, why there would be some doubts regarding the signature execution of this agreement? Well, see, one of the things we place is that there is a necessity to revoke measures of digital economy taxation to comply with the agreement of Pillar 1. So, see, Brazil's case, we have measures of digital economy taxation, but they are not specific for this economy, digital economy, and they reach also digital services. So here I would have to, in order to neutralize the existing measures, I either would revoke the existing legislation that will not happen because it's a broad one reaching many scenarios, or to create a situation of exemption to certain scenarios that were embraced by Pillar 1. But every time here in Brazil I have to create an exemption, or I have to revoke a legislation that is generating tax revenue, I have to justify from where they will have the offset regarding that revenue that will not enter the excess. So today I have a situation, we can address this, the effectiveness of the situation, that is being effective or not, but we cannot debate that we don't have this taxation. So I will have to justify, and now when I want to justify that I'm revoking or creating an exemption on behalf of something bigger, on behalf of something that can be deemed as bigger, I don't have here the certainty of how much will generate in revenues, because the measures of Pillar 1, they do not bring here something that I could say for the National Congress. Well, today I have a tax revenue of X. As of the moment I comply with Pillar 1, I will have a bit more, or any X plus something or X to offset the lack of collection. So I don't have how to make and have this commitment, because I will change something that I have to something that's its potential. This is one of the problem of Latin American countries. Many implemented, and they with tax withheld at source on digital services. So I have to revoke this measure. And then, in addition to the issue related to the quantity and uncertainty of how much this will generate, and have some other issues that are not yet answered. If I don't have companies out of the scope of Pillar 1, that will be Pillar 1 too high, 20 billion euros, and out of Pillar 2, 150 million euros. And if I have a scenario where under the income inclusion rule of Pillar 2, that it will be for scenarios below 150,000 euros, the inclusion rule is not that effective for Brazil, because we have few companies of digital economies with set in Brazil. What will happen with these companies out of the scope? I will revoke in theory, or bring a rule for exempt of the situation, but I will have a huge number of companies at the same time that will be out of the scope. So what do we do regarding this? Another thing, Pillar 1, it's the addition of part of the profit of multinational companies, amount A, with another share that remunerates basic activities of marketing and distributions exercised locally. And then OECD advises for me to measure how much is the other share of Pillar 1, the amount B, to use the method TNMM to quantify this B amount. It would be the most advised, not exclusively, but TNMM would the most indicated method. And we don't have this method in Brazil. We don't adopt it in Brazil. We saw the debates of transfer pricing on the previous panel, and advanced debates for the convergency of transfer pricing of Brazil to transfer pricing guidelines of OECD, but still we don't have the clarity regarding the timing of this change. So we have this issue yet to be considered. And Brazil, being a huge receptor of foreign investments, measures of Pillar 1 will help to have more companies operating in Brazil, or it will push them away to operate in Brazil in emerging markets, those that are not centralizing market. this is something you don't have an answer, is still considering that Brazil income tax, while many countries reduce taxation throughout the years, Brazil has the corporate taxation in 34%. And another point I would like to stress regarding Pillar 1, it's one not that much addressed and even globally not addressed. Several business of digital economies, it's based on the growth of market and not profit. Many times investors don't want to think about dividends a portion because they want the company to have an exponential growth in market value and they can generate capital gains to investors. So this capital gain to investors many times are taxed on in the investing country, and it's wealth that it's not apportioned amongst countries that generated that value. We talk a lot about the digital economy, the skill gain and scalability of businesses. That is what generates the growth and values that are exponential. And we have situations whereupon investors they place $1 million and easily they have a capital gain of 100 million or even more. These are not absurd figures when we talk about digital economies. This is a sort of wealth that is not being shared by countries regarding Pillar 1. And due to these aspects that I just listed, I understand that although debates of Pillar 1 have moved forward considerably, and the active participation of Brazil, as I mentioned, inclusive regarding Brazil's participation being in and within the steering group of PEP's inclusive framework. In spite of all this, I still see with a certain skepticism Brazil entering and executing multilateral agreement of Pillar 1 in a short term, even though we have many uncertainties regarding Pillar 1, not only those mentioned by Professor Allison, but Professor André during the morning listed several uncertainties. We are seeing it. And also that I have to revoke measures today existing. And today these measures they generate revenues for Brazil. And to do this revoke amending the legislation, I have to be clear of how much I will be able to have additionally regarding Pillar 1, recalling that amount A Pillar 1 that will be subject matter of the apportion, it's a lower value. It's smaller. I will have 25% of the profit beyond 10% of the revenues. It's not that it will be equally apportioned of the profit of digital economies. It's just a chunk, and that's why I see it far. I might be wrong, of course, but I see very far from us Brazil doing so, and countries from Latin agreeing and joining in the short term and implementing the short term pillar 1. Thank you, the attention, and I'm available. And it's an honor to be part of this panel. Thank you very much. Thank you, Professor Ana Cláudia. Really amazing the details and aspects you've showed us, not only according to Brazil's optics, but the emerging countries included. And then, with no further ado, I would like to pass the floor to Professor Belena and briefly talking about her resume, which is a huge one, But summarizing, she's director of the IBFD, active member of the IBFD, chair of this African Taxation Studies Center, very important, and director of a symposium, and acting in different boards, and also a bulletin for taxation, journal, and so forth. And she published many articles, and she's professor at Pretoria's University, Cape Town. With this, I pass the floor to Professor Belena. The floor is yours.
Thank you very much, Cláudio. And I would also like to thank the organizers of this august conference. It's always a pleasure to participate in this event. Today, I'm speaking about Pillar 1 and developing countries, but I would like to focus more particularly on Africa. Why? Because when you look at the continent of Africa, you find a lot of developing countries there. So you would find that the sort of issues that we see in Africa, you might as well extrapolate, and you expect to see them in other developing countries as well. Cláudia, could you kindly share my slide? So yes, as I mentioned, looking at the Africa perspective. Next slide, please. First, a general comment. The point I want to make before going further is that when we talk about Africa, it's very, very tempting to look at it as one homogeneous whole where everything applies the same across the board. But it's just worth pointing out that Africa is not a country. There are different countries with different levels, varying levels of development across the board. But having said that, we do see some key commonalities that lend well to a common approach. So when I talk about Africa, I'm talking about the common approaches that we see across the continent. There are places where there are variations, even in the implementation of tax laws, but we are going to talk here about the common things that we see coming through. So having made that general point at the outset, what I'll talk about in my 15 to 20 minutes, I'll start by just giving a little bit of context about Africa in the global taxation framework. Why? Because I know this is a conference focused on Brazil, and if I'm here, I think it's good that I give a little bit of context about the African perspective, and that will mean, rather than jumping straight into the discussion, maybe set things in context a bit. Having done that, I will just look at Pillar 1 and what's in it for Africa. It's all very well signing up to all sorts of things, but does Africa actually gain anything from Pillar 1? Or if Africa does gain something from Pillar 1, is it worth giving up whatever taxes are already on ground just to embrace Pillar 1? And of course, looking also at Pillar 1, we look at the concerns that have come out from Africa about the proposals on the table, whether it's to do with the substance of the proposals or actually the implementation of these proposals. I'll touch on a few further points that might be worth considering, and then conclude my presentation. Next slide, please. So when we look at Africa in context, the key thing I would like to start with is talking about the significance of corporate tax revenues in Africa. What we see is that a significant part of tax revenues from many African countries comes from corporate taxation. So corporate taxation is not a tax to be messed about with in Africa. When you look at other countries, for example, developed countries, OECD countries, in as much as corporate taxes are a significant part of revenue, it's a much lower percentage than it is in Africa. So anything that is done with corporate tax policy in Africa could have serious impacts on the ability to raise and to keep and to mobilize revenue within Africa. So it's not a joking matter when it comes to corporate tax policy on the continent. Having said that, I just want to say something about a few of the recent global initiatives that have been on the table and how Africa has responded to those. Good to look at those before we see Pillar 1, because we see that the experiences that Africa has had with these other initiatives will actually inform the way that Africa deals with the two-pillar solution. So first, when we look at the Global Forum, about 31 African countries out of the 55 signed up to that. The Multilateral Convention, 14 African countries out of 55 signed up. And that's not a bad number when you consider that there are some African countries that don't have any treaties or maybe have just a handful of treaties. So then in that sense, they wouldn't be necessarily signing up to the MLI. So 14 out of 55 is actually a creditable number when you consider the number of countries that actually do have treaties on the continent. Regarding the inclusive framework, 26 out of 55 African countries were members as at the time of the publication of the documents in October last year. Since then, there's been at least one, I think, has joined the inclusive framework. So this is just to say that Africa has been playing a role in global debates, maybe with not much influence over the past years. That's changing, but they have been present to some extent. Having said that, there have been challenges. So for example, when it came to automatic exchange of information, African countries have had difficulties implementing what had been agreed on the global basis. Why? Because, for example, lack of funding to implement the standards that were agreed on. For example, standards regarding security, standards regarding access. It's one thing to agree that, yeah, we will take part in the automatic exchange of information, but you need money to be able to put in place the robust standards. You need to carry that out. So that's one example of places where there had been issues. There were also difficulties regarding the MLI, the BEPS MLI, and the domestic measures that flowed out of the BEPS project. Why? Because when it comes to the MLI, for example, there were complexities. I mean, even developed countries had issues with complexities in the MLI. I mean, I work in IBFD and we know the sort of hoops we had to jump through just to prepare a proper treaty product for countries to use, whether with synthesized versions and things like that. So developed countries had the issues with trying to wade through the complexity of the MLI. So you can imagine the situation for a developing country, and you can imagine the situation for an African country that's probably on the lower end of being a developing country. Also issues to do with lack of capacity, for example, implementing the designing and implementing the domestic measures. I mention all this here. Why? Because it's a really useful backdrop before we start to consider the Pillar 1 issues. Next slide, please. Because when you see the sort of issues that African countries have had in trying to implement global standards, then when you look at Pillar 1 with its complexities that are all in almost every part of Pillar 1, there is a complex issue. You can already, even before hearing the concerns from the African countries, imagine what sort of hurdles have been set for African countries to jump through. So, Pillar 1, what's in it for Africa? Well, a lot of the issues that Pillar 1 was trying to address, the mischief that Pillar 1 was trying to solve, for example, the issue of how do you tax profits that are earned without there being a physical presence in the market jurisdiction? How do you tax digital businesses? How do you tax profits where value has been created? These were issues that African countries had been struggling with before the current global discussions, even now during the current global discussions. And these are evidenced by some of the unilateral measures that we've seen in recent years. For example, across Africa, you see digital services taxes coming through. There's one that was put on the statute books in Kenya a few years ago. Nigeria also with its significant economic presence rules of 2 years ago, and now some further rules on digital businesses in Nigeria. But other countries as well, even though they haven't yet implemented, had already been talking about them. So you see that in whatever part of Africa you're looking, you see that this discussion had been going on for a long time. So by the time African countries were joining the inclusive framework, or at least taking part in this discussion, going back to 2019, when the inclusive framework started looking very, very seriously at these issues. If you will remember, right at that time, there was this promise that this inclusive framework is going to be truly inclusive. That means to say there is unanimity. We will not be proceeding unless there's unanimity across the board. I'm not quite sure what's happened to that, because right now we are proceeding. Some countries have said that they will not sign, but we are proceeding nonetheless. But at the beginning of all of this, there was a lot of talk of unanimity. And why? Why was there this talk about unanimity? It was there because the issue was that there was a fear that maybe some of these developing countries sitting around the table might not agree with things, but might nevertheless be bulldozed along. And so the whole idea was every single vote there is of equal weight. So whether it's the smallest country in the world or the biggest one, every single vote is of equal weight, and we are therefore going to go with unanimity. And that would mean what? Favorable outcomes for everybody around the table. So how did that go? Next slide, please. Well, how did it go? The first thing that I should note is that two large African countries that were part of the inclusive framework have withheld signature on the proposals. They took part, they discussed, they agreed with some things, the other things they couldn't agree with, so they withheld signature. There are many reasons why they withheld signature, but maybe I'll just park one first. There is also the issue that from an African perspective, while there was a lot of engagement on the technical side, let's say from the tax authorities and all that who were participating, there was not so much concomitant activity from the political side. So I think from the Africa's perspective, you would want to see the, just like you would have the G20 and all those bodies and the G7 and all that, you want to see from the African side, for example, the Africa Union and bodies like that playing a more significant role on the political side, not just on the technical side, because then even if you agreed something on the technical side, you still need your political masters at home to okay it. So I think that's one lesson that African countries are learning from this process. But having kept that issue to one side, there were reasons why a lot of African countries were not happy with the inclusive framework proposals, and not just African countries, but also stakeholder organizations, for example, ATAF, the Africa Tax Administration Forum, WATAF, the West Africa Tax Administration Forum, and also a lot of NGOs within this sector. So let's kind of look at some of the broader concerns. The first one I'll mention talks about scope and thresholds. Some of those thresholds that were put forward for Pillar 1 before the taxing right would bite, all those thresholds and scopes in many cases did not take into account sufficiently the size of African economies. And so the amount of tax that would come within the tax net for African countries was much smaller, because the scopes were drawn in such a way that it did not take into account that many African countries, the businesses or the sales or the revenues in those African countries might not reach the level, the charging level for the nexus, or for even the sales figures. Another issue was, for example, the residual profits percentage of 25%. For example, the Africa Tax Administration Forum wanted something closer to 35%. So basically, what's the tax that's going to be up for grabs that the market jurisdictions can share? If you have it at 25% of residual profits, that's a much smaller figure than 35% of residual profits. So from the Africa perspective, a lot of countries were not happy with that. And then they start to say, well, if this is what will come in versus what we think we will get from our unilateral measures, why should we abandon our unilateral measures, which potentially could bring us more tax, and go and sign up to this Pillar 1 that will bring us less because of how the thresholds have been set, because of how the percentage has been set? So, and this point was actually made by Nigeria's foreign minister just a few weeks after the announcement about not everybody has signed up, and even though we said unanimity, we're ready to go without unanimity. Nigeria was one of those that held out, and the finance minister said, when I look at what we are doing in Nigeria regarding domestic law, and then I look at what Pillar 1 will promise us, I think our domestic law will give us is better for us than to sign up there. And it's not just Nigeria, this concern was heard elsewhere in the continent. There was also the concern that as Pillar 1 mandates the removal of unilateral measures, this could lead to a potential erosion of the tax base. So a lot of developing countries were like, well, we're already having issues with our tax base as it is, and now asking us to remove these measures will erode our tax base, when we link it also with the point that we're not going to get more in. So why should we even give up what is already on the ground? Then there was the issue to do with mandatory dispute resolution, although that's been resolved to a large extent. A lot of African countries, in fact, a lot of developing countries are not so happy with the idea of mandatory dispute resolution. It's been addressed in the proposals, of course, through some elective mechanism that would work, that applies, I should say, for smaller economies. So that's been resolved to some extent, but it's worth noting that it was an issue of disquiet along the way. Then there was the point of Amount B, which of course is would be, if implemented properly, more favorable to, for developing countries. And it was felt that Amount B lost out in terms of attention. It didn't get as much attention as, for example, Amount A and other things. So where in the area where developing countries would have benefited more, i.e. from a properly fleshed out Amount B, a lot of attention was not given there. And then there was the broader issue about the pace and the complexity of the negotiations. So the negotiations were going very, very fast. And it has been said repeatedly that it seemed the inclusive framework was rushing. They prioritized speed over consensus. They wanted to get things done by the very, very ambitious deadlines they set themselves. So that meant that it went very fast. And the thing is, if it's going very fast and it is complex, then that means automatically that developing countries will be at a disadvantage, because the complexity is something that they would not necessarily have encountered in their legislation. They might not necessarily have the capacity to deal with it and to untangle everything. So there would then be a sense of being chivied along very fast while not necessarily on board with everything. So this, I think we could say, it impeded the ability of African countries to contribute meaningfully to the global standard setting process. So these were some of the concerns that came through from the Pillar 1. Next slide, please. And I don't propose to spend too long on this, because we've been talking about the UN Article Model Article 12B. But how does it fit into this whole discussion? Of course, as we know, for the treaty provision to work, the domestic tax charge must be there. So a country must actually have a tax at its domestic level, because the treaty is not going to give it a tax in right. The tax has to be there at the domestic level. But how does this tax get there at the domestic level if it's not already there now? Pillar 1 proposal bars the introduction of these relevant measures. So you can't put it there. If you sign up to Pillar 1, you can't put it there. If you already have it, maybe Pillar 1 might be asking you to withdraw it. So there is, of course, it's not a new problem, but it's there, and it worries African countries. ATAF put out some guidance, I think 2 years ago, on how African countries that want to implement DSTs can go about designing the DSTs. And also at the same time, when you look at the ATAF guidance, you immediately see some of the limitations of Article 12B. Why? Because Article 12B, as originally drafted, applies, of course, when you're talking of a situation where there is income and there's underlying payment as a result of that income. So there has to be some payment somewhere. But there are also DSTs, digital services tax, that apply without there necessarily being a payment from the user of the service. So for example, where there is a value created by the user, but it is not the user that is actually going to pay. So maybe in the case of advertising revenues, the users are all creating value, but it is the advertiser somewhere else, maybe in another country, that is paying it. Looking at Article 12B simpliciter, it will not likely catch that type of thing very, very clearly on all fours. So for example, a type of digital service tax such as the one that the United Kingdom put together would catch something like this. So those are the sort of DSTs that African countries are being asked to sign. Of course, there is a complexity issue, even if you put it on the table, as Allison said earlier, you put it down there, but that doesn't mean that just because the tax is there, you're going to be able to collect it. But that's an issue worth mentioning. I just also want to say something about the likelihood of Article 12B making it into a real-life relevant treaty. Relevant because if two African countries sign a treaty with Article 12B, oh, well, that's very good, but what does it bring them? Ideally, you want to sign the treaty with the United States. But how possible would that be? I mean, how likely is the United States to agree to sign a treaty with Article 12B in it? And even if you go ahead with your digital service tax as an African country, put it in place, what could there possibly be any retaliatory action? Thinking here of the United States, we know the recent history. United Kingdom, France, a few others were threatened because of their DSTs. And at least as at last year, UK and a few others had undertaken to withdraw this tax and not collect money under it for the time being. So it's all very well saying, yes, you could go your own way, put that tax in place if you think it will help you, but in real terms, assuming the tax would even catch anyone and can be properly implemented, there is a risk of a retaliatory action from a country that may not necessarily agree with that. Next slide, please. Okay, so in conclusion, we're looking back at Pillar 1, what do we see? I think we can say it's a mixed bag for Africa. Mixed bag, why? Well, on the plus side, it's given attention to the concerns of developing countries. Never again will anybody, any organization such as the OECD or anyone, sit together and say, yes, let's come up with a global standard without thinking of developing countries. I think it is now clear that you cannot have a global solution unless you consider developing countries and unless you consider the African situation. So there's been a serious attempt at proper multilateralism. If you compare this with BEPS 1.0, where we had the 15 actions, and there was an outcry because developing countries were not really taken along in that process, that's a great improvement when we look at where we are now. And that is on the plus side. On the minus side, though, the imbalance still remains regarding the allocation of taxing rights between residents and source countries. Like I mentioned to you when we looked at the Africa concerns on Pillar 1, we looked at the scope and the thresholds, and we saw that these scopes and thresholds did not, even though there was some little bit of concession for smaller economies, did not go far enough. We also saw the issue about the percentage of residual profits that's up for grabs, not going far enough. That still maintains the imbalance between taxing rights for residents and source countries. So there is still some way to go to achieve global consensus. There are great efforts in place, but a long way to go. Thank you very much.
Thank you very much, Professor Belema.
Thank you, Professor Belema. Your presentation that brought strength of many concerns and perceptions when we analyze what is happening with the African perspectives. And with no further ado, I pass the floor to Professor Yari. The next lecturer, Yariv Brauner. He also has a CV which is very long and summarizes his tax law professor at the Florida University, lecturer in many American and foreign universities. He wrote several books and articles on the subject, and he taught many courses in tax law and public law and international resolution of disputes. Professor Ari, with no further ado, please take the floor.
Thank you very much, and thank you very much the IBDT and the organizers. And do you want me to share the screen, or are you going to do it? I can do it, I think.
The way you prefer, Professor.
It doesn't matter. All right. Can you see it? No.
Yes, we can.
Yeah, it's not this. All right. Okay, so being last, I have the good fortune of not needing to worry about rebuff. But on the other hand, I'll try not to repeat what the others have said. If you got a melancholy atmosphere or a melancholy view of Pillar 1, I think I will make it a little bit more somber, unfortunately. So as an introduction, I think this is really important to remember the process, and I was very happy that Professor Christians presented it between the two pillars, because I truly view the entire project at this point quite similar to the way that she presented it, as living in that zone geographically. But our job here is to focus on pillar one, and I will try to do that. Remember the background. The background is not just to tax those multinationals. This was maybe the original sin of the BEPS project, in my opinion. An important part of the background to that is countries, developing countries, emerging countries, whatever you want to call it, wanted a fair New Deal. They wanted to tax the digital economy because these were the large corporations that were operating within their jurisdiction according to their understanding without paying sufficient taxation. And my predecessors explained some of the limitations. And then that was going for a long time, really, until the OECD Secretariat, an obviously illegitimate body, comes out with a unified approach. As you remember, this is the original Two Pillars program. And that program stalled for a while. Eventually, we have the October 8th agreement, which is really a dictate, literally a dictate by the United States that grew up to the agreement we're talking about today. And the key aspect of this is that the entire project is about the DSTs, and that's really important to remember. This is what the United States wants. This is what the OECD leadership, I guess, wants. And therefore, that is the measure stick that we need to use when we think about the politics behind, especially Pillar 1. Others have said before that Pillar 1 lags significantly behind Pillar 2. Amount B lags even further behind. And that is really a concerning matter in terms of general politics or maybe even the politeness. However, and I won't elaborate on that now, but maybe if you want, we can talk about it later in the questions. Pillar 2 suddenly presented us with an interesting development with the QMDTT. Professor Christians said that this is a horrible acronym, but to me, it's a shining light in terms of the opportunities for developing countries in this process. Now, we have to remember that the minimal impact of Pillar 1 makes it almost a non-issue, really, in its current form to most developing countries, at least the way I see it. The opportunities, ironically, in Pillar 2 are so much larger. Nonetheless, let's talk a little bit about what we do know about Pillar 1. So what we've had until now is a set of model rules that were presented by the OECD. The idea that, at least that's what the OECD says, that these will be later incorporated into tax treaties, and countries are going to simply adopt them or follow them, very much like they want to do with Pillar 2. However, in this particular context, there has to be a tax treaty. I think there is a multilateral tax treaty. I think there's consensus over this this matter. Obviously, there's a horrible problem of legitimacy in this process. Since when the OECD started dictating domestic tax law for the various countries without a prior conversation about this? This is quite a serious precedent, especially when these rules are really problematic. So if we go into the details, I didn't do it in a logical sequence necessarily, but rather in a kind of chronological sequence. And I cannot cover everything in the time allotted, but I'll just mention a couple of things. So first, we have a nexus rule. The nexus rule is limited to amount A, and it is solely revenue based. As such, it's really not a nexus rule, right? The whole idea. Excuse me. All right, I have now a problem, sorry, with the translation.
But we are hearing you, Professor.
Yeah, I know, but I hear the translation in Portuguese in my ear. All right, no, never mind. Okay, let me go back to this. All right, so when we go to Nexus, we see it is solely revenue-based, and therefore it's not really a Nexus rule. The whole idea of Nexus is that you have sufficient activity in a particular country to create this taxing right. And now it's a single amount, or basically a single amount. Others have written and demonstrated the problems with that. But of course, when you have a single amount, the impact of that amount in different countries is very different and very unbalanced. And this is quite easy to resolve, but the OECD refused to resolve it. If you think about this rule, it's much more amenable to formulary taxation or consumption kind of based solution rather than to fit into the current international tax regime. My general point on this is that it seems to be that these rules were written not so much to actually be implemented, but rather to create, something that people can discuss, whereas the real serious effort, if you can call it that way, is really on Pillar 2. So to me, there wasn't a serious effort to implement Pillar 1 in a way that could be compatible with the current international tax regime. If we move to source, the OECD says the purpose is to balance accuracy and compliance cost. However, it says the categorization is going to be based on substance and not form. Now, we all know that whenever we talk about this kind of things, this will lead to tremendous amount of litigation. And unfortunately, OECD has not presented an opportunity for unification, but rather for more differeces among countries in this context. In addition, companies will have to use detailed record-keeping mechanism to be presented in the future. But the main problems are actually in the rules themselves. First and foremost, the rules go back on the original promise of the OECD or the original goal of the OECD, not to ring fence the digital economy. So there's clear ring fencing in this case. The rules themselves, to me, are actually quite lazy. If you think about it, they are extremely problematic. Let's just take some examples. In advertising services, it's going to be the location of the viewer. Many comments have said how difficult this is going to be, but it's also conceptually problematic because it's a circuitous analysis that's required here. This all depends on the advertiser himself or herself. There are also efficiency implications in this context and beyond the obvious administrative costs on the taxpayers. In B2C, it's the location of the customer. Yeah, remember the whole problem with B2C that has been discussed for forever is the difficulty of imposing everything on the customer location. Now, how are you going to do it? The OECD says, well, we're going to use billing addresses and phone codes. This is going to be a dramatic, actually, requirement, because think about what that means. That means that now there's legitimacy for the various companies, and a requirement for the various companies to collect data that they might not have been collecting in the first place, because they have to collect it for purposes of compliance with tax law. Maybe I'll just use one more example. For user data, it's the location of the user. Obviously, this is something that they haven't thought about seriously. What does it mean, user data? Does that mean that now Google has to identify every person that it is using its artificial intelligence or machine learning, by the way, tools to collect data about? Is it only useful data? Is it any kind of data? The OECD says the indicators are going to be user profile info, geolocator, and IP addresses. What they're thinking about is that now all of this will be collected even by companies that have no interest in collecting this type of information in the first place. What are the implications from privacy perspective, etc. Maybe I'll stop here because there's a tremendous amount of difficulties in these contexts. My suspicion, though, is that the problem is going to be that everything is going to, again, rely on future commentary on these rules. And who's going to write the commentary? Again, it's going to be the OECD Secretariat. So this is clearly not an inclusive process, and it doesn't have a principled direction behind it. It's simply an attempt to write some rules that sound okay. What are going to be the relationship between these source rules and the regular source rules? And why? Why to distinguish between the two? This is completely lacking. The rationalization is completely lacking throughout the process. If we talk about scope, the obvious question is why tax only the largest corporations? This is clearly inconsistent with the decision to have a revenue-based nexus. If a small or medium country has more sales and more revenue in a particular country, why would that company not be taxed and the other company be taxed, even though it has the less revenue in that country? This may raise also constitutional issues, domestic and other law issues. Others have written about the carve-outs. They don't make sense as well. Why only extractive and financial industries? This has a bad smell. The excuse used by the OECD is that these are regulated industries, but there are also many other regulated industries. Why only these? Obviously, I'm sure you're going to discuss it in the Pillar 2 context. The choice of financial accounting as a baseline, I think, is going to be dramatic. The OECD is playing this game as if, use accounting, financial accounting, and everything will be easy because everybody's using the same rules. It's easy. There's just a unitary system. Well, everybody who's ever dealt with accounting knows that that's not true. And in addition, there are details there that make it extremely difficult for several countries to operate. Brazil, for example, the Brazilian GAAP is part of an equivalent system that is acceptable, but not every country's internal tax accounting is considered equivalent. So there are a lot of technicalities here that are obviously tilted towards the rich countries. And why it's tilted toward the rich countries? Because the rich countries are going to benefit the most from Pillar 1. And this has to be understood, including the United States. And I'm going to come to that point a little bit later. There's an obvious administration problem that a lot of countries, and Belema just mentioned that in the context of Africa, where countries like Nigeria, but I think almost every country, in the end of the day, if it did its homework, it should say, it's not worth the hassle. especially when you think about it really deeply, what's going to be the impact on accounting, what's going to be the impact on actual investment, on corruption, on a bunch of stuff that these new rules are going to be affect seriously. Finally, I don't think anybody believes we're going to have a multilateral convention that will include many of the headquarters countries, because definitely the United States is not going to sign one. And then how does this system work? Belema also said that the dispute resolution process was originally problematic, but now it sounds to be okay because it's going to be elective. Well, if it's elective, it is not a real final, easy to implement dispute resolution mechanism. And most importantly, it's not going to give us the basis for the development of the law in a way that such a gigantic project should have. For the sake of time, let me just say a couple of things about the United States. Obviously, the United States, like in BEPS, has moved from leadership in the program into playing defense in the program because of the distinct impact that was mentioned before on US multinationals. On top of this, the United States has significant political issues. Remember, the current administration is expressing a lot of confidence that it's going to implement these rules, but it wasn't able to do so in our Congress, and every prediction of the coming election is that the Democrats are going to lose at least one of the houses, and that will make it even more difficult for them in the current political environment to pass anything. There's no question that it cannot pass, it will not sign the multilateral conventions. But Pillar 1 is great for the United States, because if you think about it, the United States is going to earn, to have the most opportunity of collecting revenue, little revenue in comparison to the other stuff, but in comparison to other countries, it will be the biggest benefactors of Pillar 1 as it is. From a universal perspective, of course, we have to ask ourselves who benefits. Others have discussed it. As I said before, I think that the QMDTT and DSTs in general, because even though the current agreement says that DSTs must be revoked, well, what about taxes that look like DSTs, that are similar to DSTs, that are not called DSTs? So there's a lot of margin there to operate for countries. All of it is going to be quite problematic for the international tax regime, because it will result in less, not more, unity and standardization of the rules. The EU has tried to push a directive, as many of you know, and was not successful on Pillar 2, because for example, Poland said, well, without Pillar 1, I'm not going to sign, I'm not going to agree to the directive on Pillar 2. And if Europe can't do it, think about the global picture. I think complexity, a lot of people say, well, it's complex, but we are sure we can overcome it. And what's the solution of the OECD? Capacity building. We're going to help you developing countries to solve this problem. But that's not a panacea. And of course, capacity building it has a built-in paternalism element that again makes sure that developing countries don't have a voice in this process, which is the original sin here. Anyway, I think also the fact that the United States will not be a primary participant in the process is going to cause a lot of countries to say, well, if they don't do it, why should we give up revenue? And therefore, I think the future of Pillar 1 is extremely unclear. Unfortunately, I think this was intended. All right, thank you.
Thank you, Professor Brauner. with the explanations that strengthen the complexity of the subject, difficulty to implement, and more we can notice we increase the doubts of who benefit, and even those who benefit, they have difficulties to implement, as you have mentioned in the case of United States, especially regarding the convention and further challenges. With this, we are at the end. We have still 8 final minutes. What I would like to do is pass the floor briefly for final remarks by the lecturers. And so, with no further ado, Professor Allison, if you would like to say something in 2 minutes, then we move forward with the final remarks.
Sorry. I don't think I necessarily have too much to add here, but I thought I did see some questions in the Q&A. And one of the questions, which I had to put in Google Translate, of course, one of the questions was about, well, is Brazil's current tax policy position compatible with Pillar 1, Pillar 2, the OECD, whatever. I hear this question all the time. And I would love to hear what people say about that, because I find it supremely perverse that the OECD, in inviting Brazil in, says now you have to get rid of fixed margin returns, even as the OECD is pumping fixed margin returns in the form of Pillar 1, amount A, amount C, even amount B too. I mean, really, it's all through there. So for me, the answer there is, if you want to understand global tax, you have to think about global geopolitics and the politics of Brazil's position vis-a-vis transfer pricing, vis-a-vis permanent establishment, vis-a-vis fixed margin returns. All of these are being adopted all over the world, even as the rest of the world, or the OECD, is telling Brazil to stop it. So I think this really tells you something about our understanding of what it is we're doing. Sometimes it's about technical rules, but mostly it's about getting comfortable phrasing or ideas about norms and then sticking to them even when what we're saying is nonsense. It doesn't make any sense anymore. I think that's where we're at. I would be interested to hear what others on the panel say about that. Thank you.
Thank you, Professor. Now I pass the floor to Ana Cláudia. Thank you. Well, it was great, very interesting, the panel, and see that doubts and uncertainties are for all sides and all countries. And the comment when Professor Allison said, what would be your Brazil, any other countries is compatible to the pillars, I would say here, not only this morning's debate and the panel, I think no country is compatible with the pillars for the time being. So a lot yet to be addressed. And we will need a lot of development and the adaptation, so forth. We notice this need that countries have of having the effective certainty legal-wise, and the pillars since 2018, the issue of legal certainty, something that was always present on OECD debates and speech. But up to now, after 4 years from the interim report, an important landmark in this debate, we still don't have the legal certainty of what truly can be implemented in such a way that my impression, answering the food for thought posed by Professor Allison through the Q&A, if we look today, no country is aligned and compatible with the implementation that would be easy of Pillar 1 and 2. I think we need a lot of work. That's why I don't believe personally in the implementation of the pillars in a short term. Perhaps we will have measures in the sense of the pillars, but measures adopted throughout the years and not only at once, as is the intention of OECD regarding the framework. Thank you, Professor Ana Cláudia. Now, Professor Belema.
Thank you very much. Just 2 points I want to make here. The first is to say that I think some credit should be given to the OECD inclusive framework for attempts that have been made towards a global solution. And also what I see is adjusting as we go along. Okay, so there's feedback and then they're immediately back to the drawing board and adjusting a bit and really taking a bit of care with the public meetings, etc. So I think it's good. I think whatever may be the substance of what comes out at the end, the process has actually corrected itself along the way. So I think a lot of credit should be given for that. The second point I want to make is that I agree with Yariv about this thing where whenever complexity is mentioned, then immediately like knee-jerk action, oh yeah, there's capacity building, that will solve it. And indeed, as Yariv says, capacity building should not be a panacea. It is not and should not be used as such. I mean, working in IBFD where we do a lot of this sort of work, what I've found is that for capacity building to be effective, it calls for in-depth knowledge of the local laws of the country where you are doing this training, not just saying, oh, here are these new laws, we're going to explain to you how you can put them in your law. You need to know the local laws of the place, you need to know the quirks of the local laws of the place, and you need to know how those local laws will interact with the new laws that are being brought in. So it should not be a top-down approach because that could come across as paternalistic, but it often comes across like that, like, oh yeah, we'll just bring some training and then you're good to go. It's not. It's a much more involved process than that, and I think that really ought to be taken into account when these sort of measures are proposed. Thank you.
Thank you, Professor Belena. Now I pass the floor to Professor Brauner.
Yeah, thank you. Maybe I'll just say a couple of things. One is that, in my opinion, no country really knows how it's going to come out of Pillar 2 and Pillar 1. And I think that's really important, demonstrated to an extent in the context of Brazil by Professor Utumi. I think it was very important that you mentioned as well in her original presentation the availability of some taxes that could be used, and this is true for other countries, but definitely true for Brazil. I think the smart countries are going to try and utilize available mechanisms in their domestic laws to adjust to whatever's going to come up. But we still don't know what's going to come up because the details are going to really matter for different countries, and what's going to be the dynamic impact? What are companies going to do? This is going to change quite significantly the way corporations are going to actually operate and make decisions in this matter. And in that sense, I share Belema's almost everything she said, except for the fact that I think it's really good what the OECD is doing, because I don't think this is the right approach. I think it is only done to preserve the power of the OECD and the countries. I think, theoretically, having everybody sit together and talk about things is good, but that's not exactly what's happening in this process. Remember, everything, the entire architecture, the entire agenda, the rules, the actions, everything was decided, including this current agreement, at the level of the Secretariat or the US Treasury. This is where things were written, were established, and only later everybody else were invited to agree, kind of. So thank you.
Thank you, Professor Brauner. And finally, I pass the floor to the chair, Professor Anderson. Your final remarks and to end the panel. Thank you, Cláudio, and all that participated and followed our panel regarding hard and difficult subject posing many challenges ahead of us, but all brought light from different ways of seeing it. It's a walk. We are still far from reaching the harmonization, but we know how difficult it is. It's a difficult road and path and with challenges, but the perspectives you posed bring light to this. Thank you very much to all that stayed with us today. Cláudio for the dedication, the formatation, and organization of our panel, and thank you Professors Allison Christians, Belema, Ana Cláudia, and Professor Yariv Brauner that shed light to our panel, made it brilliant. Thank you, the organizers and coordinators of this panel and the event, Professor Luiz Eduardo Choeiro, Flávio Neto, and Maito da Silveiro. Fantastic event and inviting all to follow the last panel of the day, and good afternoon, and we close our panel now.